afternoon, my people. What is going on? It is your man, Charles Tank Harris, the founder and chief visionary officer of the financial literacy platform Wealth Our Way, where our motto is wealth is not only for the wealthy. Today is Friday, June 11th, 2021. I'd like to thank each and every one of you who are watching this program broadcast live on Facebook or YouTube. I also like to give a special salute and shout out to Wealth Our Way Nation, who watches this pre-recorded over the weekend, at night, lunch break, wherever you can get 15 minutes to squeeze your financial literacy in. I am wrapping up this week's Portfolio Building 101 teaching module. So I'm going to just real quick, before I do though, I want to make sure you guys know we are 4 people away from 1,000 likes on our Wealth Our Way Facebook page. I don't know if you can share this broadcast. I don't know if you can tell a friend, but I really would appreciate over the weekend getting over 1,000. Means a lot to me. I thank you guys for your efforts. With that being said, I want to review what we covered this week in portfolio building. We started off with the, home room furniture strategy that I've analogized for company you work with, account that you open, investment that you place in the account. We did that on Monday, Tuesday, and Wednesday. Yesterday, we looked at what an actual asset class is. It's so important to understand asset classes, how they work with one another, all of those different things. And yes, I am well aware that it is Real Rap Friday. Content's been created, waiting for my intern to upload it. Unfortunately, she has a day job, so I didn't get it to her in a timely enough fashion before she went in today. So Real Rap Friday will probably be released a little after she gets off work. Stay tuned for that. I love that you guys love the content. I will create more. I'm working on it every day, and I love doing what I do for Wealth Our Way Nation and the Wealth Our Way family. So with that being said, we are wrapping up this portion of the lesson by talking about a white paper that I wrote, probably about 12 years ago, called Dare to Be a Great Investor. D for dollar cost averaging, A for asset allocation, R for rebalancing, and N, where did I get N from? And E for expenses. I know what I did in my mind. Expend, I focused on the N sound. Anyway, Dare to Be a Great Investor. We're going to go to the screen share. You see, I bought the screen share back this week. It had been a while since I had gotten to it. Bang, we're back in the screen share, and we're going to talk about Dare to Be a Great Investor. Let me see something here. This might even be better if I break it down like this for you guys. Let you see a little more of that. You don't need to see me all the time. I'll pop back in from time to time. Dare to Be a Great Investor. Let's approach the D first. Pause. No, dollar cost averaging. When we talk dollar cost averaging, you've heard me say that many, many times here on 15 Minutes of Finance. It is a core belief of mine as a wealth guide and a financial mentor to people. I firmly believe in dollar cost averaging. Trust me when I say there are people out there who argue against dollar cost averaging. I'm going to tell you why I believe dollar cost averaging is something that everybody should be doing who is a long-term investor. Let's start with what dollar cost averaging is. The first component of dollar cost averaging is taking a predetermined amount of money to invest. You're going to be interval investing, whether that interval is once a month, once a week, daily, quarterly, semi-annually, once a year, doesn't matter. You're going to take a predetermined amount of money and allocate it to your investment portfolio at letter B, that predetermined time interval. So we talk all the time about one of the steadiest tools that most of us use for retirement is our company sponsored retirement plan, normally in the form of a 401k or a 403b. That is a true dollar cost averaging vehicle, even if you didn't know what dollar cost averaging is. Because as I've pointed out before on this program, every time you get paid, some portion of that paycheck gets put away for your investment portfolio. And what happens about how you get paid? you get paid at a set time interval. So you get paid every 2 weeks or twice a month, or you get paid every Friday, you get paid once a month. Whatever your time interval is, you're getting paid, and that predetermined amount of money, normally in a retirement plan, it's a percentage basis of your income, is going into the portfolio that you've chosen every time you get paid. That is dollar cost averaging. So I said to you, some people don't rock with dollar cost averaging. Some very, very smart people don't believe in dollar cost averaging. Why? I want to always give you the other side of the coin. Most people who are against dollar cost averaging, they think about the stock market and the bond market the same way I do. They believe in it, and they believe that over time, what you start here at goes up over time. So their argument is, why would you not put in as much as you can as soon as you can so that you don't miss any of the upside? I understand that belief. Here's my counter to that. We are not investing in a bubble. We are not investing as robots. This is a very human experience. And I'd say the vast majority of investors have a very, very hard time stomaching the downs that come with investing. So if you were to put everything in today, and every time you get some new money, doesn't matter when it is, just throw it in, you'd be subject to all of the drops and basically seeing if you can stomach staying in. When you have a systematic approach, this takes some of the emotion out of it. It provides you with a level of emotional comfort. I've used this example all of the time. When I wake up, and I shouldn't do this is bad. I shouldn't share this with you guys because I don't advise you to do it, but I do it. This is a do as I say, not as I do moment. I check my investments every day, mainly because I'm giving financial advice and I want to know what's going on so I can talk to you guys. I don't think anyone should look at their investments every day, but I do. What I feel every time I look at my investments, when I look at my screen, and some is red is bad, it means it's down, and some is green is good, it means it's up. I have an emotional level of stability because I know, hey, the red stuff that's down, yeah, I've lost some money, but I got an opportunity to buy it at a cheap price now. So I'm both happy and sad. Conversely, when it's all green, I'm feeling good because I made some money, but I'm like, darn, I want to put some more money in on Friday and it's going to cost me more. So what it does is it gives you the yin and yang experience. You're always balanced. You always have some good and some bad, regardless of what the market is doing. That emotional comfort will keep you engaged in your plan. I tell you guys all the time, the only plan that works is one you'll stick to. Asset allocation is the A in D.A.R.E. What does asset allocation really mean? Well, experts say the strongest factor in what your portfolio will return is determined by the asset allocation. What does that mean for my audience? Well, a lot of people believe that picking the right investment is what determines your returns. That's not true. You can pick a Microsoft when Microsoft first comes out and think that, hey, I've hit the cover off the ball, but I guarantee you that you've also picked, Netscape when it came out and it went to zero. So, AOL acquired it, long story. The reality is that stock picking, bond picking, is not how you determine the majority of what's going to happen in your portfolio. Having an asset allocation that creates diversification, the second part, so that when one part of your portfolio is up and the other part is down, you get that balance. When you get that balance, overall, what it does is it reduces your risk. Risk is measured as volatility. That's what risk is measured as. The difference between yesterday's price and today's price, that volatility is risk. The ability to be down 30% or up 50%, that range is volatility. If I put two assets together that shrink that range, it shrinks the volatility. So it reduces risk. Give me a second as I clean up my screen share. So rebalancing, the R in D.A.R.E, rebalancing of your portfolio. What does that mean? Well, I create an investment policy statement for my developing, transitional, and mastery clients. It guides them as to how they should be in certain percentages. We don't let more than 10% of our portfolio ever be in one particular stock or bond. We don't let more than 20% be in a particular sector or industry. We don't let less than 5% be in cash. These are different guardrails that we give for a portfolio. What that does is it forces you to do what you're supposed to do in investing, which is buy low and sell high. For example, if you bought a stock that went up 300%, but you know you're not supposed to hold more than 10%, the odds are it's grown out of that 10% band. Rebalancing makes us sell some of that stock to where it's now only 10% of our portfolio, take that money and put it into an area that underperformed. That's what rebalancing means. I'm taking the strong performers and using them to fund the laggards, because everything comes in and out of favor. We talked about that yesterday with asset allocation, asset classes. So if everything's going to come in and out of favor, the guys that are doing bad today will do good in the future, and the guys that are doing good today will do bad in the future. Take the money off the table, reduce your emotional trouble by knowing that you're balanced. But you do have to find the time that works for you. You can rebalance quarterly. You can rebalance semi-annually. You can rebalance annually. Know what works for you. You rebalance too often, every time something goes up a whole lot, you're going to create trading expenses and you're going to create taxes if you're in a taxable account. So make sure you find the time interval that works for you. So I am turning D.A.R.E, the white paper, into an ebook. That ebook will be out in July. It's going to take a much deeper dive into every element of this and truly talk about how to build a portfolio, go much further than I can go in 15 minutes. So stay on the lookout for D.A.R.E to be a great investor, the ebook. The last acronym in D.A.R.E is E for expenses. When I tell you that you have no idea how over time 1% makes such a huge difference in the amount of money that you will have. If you are a 40-year-old looking to retire at 67 and you earn 6% after expenses as opposed to 7%, and let's just say you were putting $1,000 away, your difference could be somewhere around $40,000 to $50,000. I'll actually run the numbers and put that on another 15 minutes of finance. I have it on our software. You can do it yourself at the Wealth Our Way website. Just go to the compound interest calculator under resources on all of our calculators, and you can play around with what happens if I get an 8% return, what happens if I got a 9% return, and see how much a 1% difference makes. Where's that 1% going? In most instances, you're paying for a fund manager. And I tell people, don't pay for what you don't need. The best thing you can do is get good advice, get an asset allocation, maybe get an investment policy statement, and then fill out your plan with low cost index funds or low cost exchange traded funds. They normally mimic an index. They're very, very inexpensive. That 1 to 1.5% that you can save over an actively managed mutual fund, so long as you're offsetting it with the cost of the advice. Once again, on our foundational level, it's $47 a month right now. We are opening back up in July because we're closed now, and that price will go up, but it will be under the original $79 that we had started at. That difference at 1% will save you a bunch of money. Lastly, beware of what you aren't told. When you're looking at different funds and their internal expenses, trading costs are never in that prospectus, because by right, the fund company can't know what their trading expenses will be. Also, a lot of actively managed funds carry gains from previous years. You can be buying into a fund with a huge appreciated tax liability. You're going to have that tax liability distributed to you. Those are all expenses that can drag down your total return. So I didn't think I'd get through this in 15 minutes, but I did. Dare to be a great investor. I will make sure that this is posted on the website as all the 15 minutes of finances are, but the ebook will come out and take a deeper dive on this. And I look forward to talking about next week. We're going to talk about housing, since it is Fair and Equitable Housing Month, the month of June. We're going to talk about housing again. So I want you guys to have the best weekend. I hope that this week on portfolio building really, really helped you, really put your mind at ease. And as always, I'm open for emailed questions at info@wealthourway.com. And you know my motto. You know what I'm going to tell you. Wealth is not only for the wealthy. Have a great weekend.